What's up, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to be doing an update analysis for the Trade Desk stock. I made a video on this a couple weeks ago, and the stock was much higher at that point. Let's just say that. And as you can see, I got 15 shares at about 73 bucks a share because at the time, $73 a share seemed like a pretty good deal. But now I'm actually down 26% because the trade desk has not stopped falling. It's been insane. Just 4 months ago, this stock was $140 and now it is down to 50. So it's crazy how much the stock has fallen. And this is what I always talk about with these stocks that get hyped up where the P ratio is 100, 150, 200. It's like people don't care about the valuation ever. And pretty much every single time, I can't think. I think every single time it comes back down to reality. And best case scenario, you have a stock that trades at 50 times earnings. If you have an Apple, Amazon, Nvidia, Costco, just best of the best businesses, you might be able to get away with a 50, 55 P ratio for years and years. But when your stock trades at 100 times earnings, it's almost guaranteed to come down. And that is pretty much what is happening with the trade desk. As you can see, we pretty much have almost eliminated the last 5 years of gains on this stock, right? I mean, 5 years ago, this stock we're approaching when it was just 40 bucks a share. So I don't know. I keep going back and forth with whether or not I want to buy more shares of this because I think it's possible this stock, as you can see, there is quite a bit of resistance at around that $43 mark. And so if it goes around there, if it goes between 40 and $45, then I'm probably going to feel more comfortable with buying some more shares. But still, I mean, this is one of those stocks where even when the stock drops like this, the valuation is still not cheap. Right now, we're looking at a forward PE of 48. That's not cheap. By any means, that is not cheap. Now, compared to 126, like it was a year ago, sure, it looks cheap, but it's really not cheap. 48 times forward earnings is a lot. That means that company better be growing at 40% a year or something, which this company's not. The revenue the last 5 years is averaging 29%, and the last couple years it's slowed down to 25%. Then we go to net income. Net income, the last 3 years looks great, right? I mean, they just did $393 million in net income, which is really not that good considering this company's nearly a $30 billion company valued at $30 billion. But I mean, look at the last 2 years, 171% net income growth. Last 5 years, 29%, which is obviously brought down a lot because there was this decline here after 2020. So I don't know. I like their business model. I like the business. Let's see what are their profit margins. They got margins of, let's see here, 16%. I thought they had good margins. Return on capital, 13%. That's okay. That's okay. And profit margins of, let's see, let's go in here. 16%. Again, yeah. So it's at least trending up, which I don't know. 16% is good, but it's not amazing. And so I don't see why this company is valued at what it is. I really don't. Even 11 times sales is still, that's kind of a lot. That is kind of a lot. And so again, I like the business. I like the numbers look good. Obviously, they're growing. It's heading in the right direction. How's the other metrics we got down here? I need to see cash to, yeah, almost 2 billion in cash, no debt. That's good. That's really good. Shares outstanding, good. So again, I like a lot of things I like the position they're in. I like the numbers, the growth. You just got to be careful with the valuation. The valuation does scare me. And especially when you look at a chart like this, here's the last 2 years of the P ratio. And at one time it's traded at 400 times earnings, which is insane. And as you can see, pretty much every month it's gotten to a lower and lower valuation. And now we're sitting at 70 times trailing earnings, which is insane considering what do analysts have them doing for growth next year. We're looking at, again, EPS of 1.6 to 1.6 last year, 1.8 expected this year, and then 2.2. Those are good numbers, right? There's no denying that. It's heading in a good direction. But are you willing to pay 70 times earnings for that? I don't know. And if we look at revenue growth, 18 to 20%. Now it is 18 is going up to 20%, which is that's a good, it's accelerating, which we do like to see that. But still, we're talking roughly $3 billion of revenue for a company that has a valuation of what, 27 billion? Yeah, 27 billion roughly. Now let's go down here. We got Robinhood investors are investing in this. What about hedge funds? Not really. And insiders? No. Definitely they were selling at this point. So again, I don't know. This is a risky one. But I would say when it comes down to 40 bucks a share, maybe $45 a share, then it looks a lot more attractive and I'll probably make my position a little bit bigger. But right now I purposely have it small because I know this is going to be a volatile stock. So that's the way I'm looking at this one. The numbers look good. I do like the numbers as far as, the business and stuff, but as far as the valuation and the way the stock is currently valued, I'm not a big fan of that. I think there's a problem there and I think even if they put up these numbers, let's go back here. What's their net income again? A couple hundred million. Let's say they go up to a billion or $2 billion in net income a couple years from now. Well, okay, you're pretty much pricing that in. You're buying their cash flows and their net income from 5 years out today, and you're paying that high premium for that, and that means the stock has nowhere to go. Then that's what that means. So that's kind of my thing on this is it'd be nice if you could get this at a cheap valuation, which you can get other stocks that are growing at 20% and the P ratio is only like a 20. So why not just do that? That's what doesn't make any sense. It's just these stocks that get hyped up for no reason pretty much. And that's why I'm not a fan of those. So that is my analysis for the trade desk. Let me know what you guys think down below and I will see you in the next video.